Rupee opening actually has been slightly on the higher side, 83.08 compared to a close of 83.11 that we saw yesterday. And that's the opening bell that you can see. First tick on the index is absolutely flat with a bit of a positive bias, you'd have to say. The Nifty hanging on to the 19,400 mark. The Nifty Bank actually is supporting, up almost about 100 odd points right now. And what's leading from the front is a couple of these Adani Group stocks. Adani Enterprises, Adani Ports are in the green. You have HDFC Life that's up almost 0.7%. UPL, Power Grid, BPCL, a couple of other stocks that are in the green right now. And L&T, LTI, Mindtree, Sun Pharma, Titan are a couple of other names that are holding up at the moment. What's not looking good this morning is Reliance Industries. It's a tad bit soft. I mean, nothing alarming. Tata Consumer Products and a couple of these IT names coming off a tad bit. Infosys is down almost about 0.2%. Bharti Airtel, Eicher Motors, Britannia are a couple of other names that are just trending in the red right now. So all in all, you'd have to say that, there's that deal, by the way, on SGS Enterprises, where 33% equity has changed hands. Nimish was telling us about that. So keep that on your radar as well. But by and large, the market is very quiet. The opening is very quiet. And you'd have to say that individual stocks are, a few newsmakers here and there. On the upside, though, Adani Group stocks are topping the charts this morning. But Nigel, what else are you noticing in the broader markets this morning?
Well, one stock that's reacting to Nimish's standard brokerage report, Citi on Oro, they've downgraded the stock, as Nimish told us, from buy to sell. Revised target price at around 750 rupees, so that one's down 2.5%. IEX is pulling back a little bit. It's down closer to around 2% as we speak. On the flip side, you have NCC that's up close to around 2%. What a big move that stock has had. Year to date, it's up close to around 80%. It's moving very, very well. India Bulls Housing Finance as well, up close to around 2% to kickstart trade. And a couple of other notable movers, I think Adani Power, that's one of the big volume movers today. Well, that stock, in fact, is up close to around 5% as we speak. Lemon Tree as well, up 2.5%. So a pretty good start, actually, from a broader market perspective, though the headline index, as we said earlier, is still in a bit of that range.
For the second day running, the Adani Group stocks are basically what is leading, and we were discussing that with Hemang in the morning. Adani Transmission, Enterprises, Power. So those were a part of the Nifty, and outside the Nifty as well, doing quite decently well. What else? Jupiter Wagons is once again locked up, limit up 5% higher. Stocks at about 300 now. As we were pointing around the same time yesterday, some 200, 250% this year. Lemon Tree, we highlighted. Scient DLM will come up. It did very well yesterday, and it's up another 2.5%, 3% this morning. There is Chennai Petro, which is up 2%. Stocks at about 376. There is Repco Home, which is up about 2.7, 2.8 odd percent. Car Trade is up 4%. There is Brigade, which is up about 2% or so. And then, volumes kind of start to taper off. This is the bulk of what is doing well with decent-sized gains. So Geo Finance, I think Geo Financial is down 5%. Like yesterday, there is a bit of a selling pressure which is there. So 236 on Geo Financial as we start. IEX is down 1.25%, and there is Titagarh, which is down about 1.6 odd percent as well. And of course, there's the big block of SJS. Stock is absolutely flat with a 1% sort of move lower. 15 points on the Nifty. So this is really quiet so far. So let's see. 19,400, just above 19,400 is where the Nifty is holding up for now. Andrew Holland is with us, Chief Executive Officer at Avendus Capital Public Markets Alternate Strategies. Andrew, good to have you with us here. Thank you very much. Go where the momentum is. That's some, not your philosophy, but that's worked for you. So where are you finding momentum?
Not sure we're finding momentum anywhere at the moment, Prashant. It's kind of one of these markets where we keep kind of flipping on the kind of negative to recovering. But I think that still the risks are to the downside for a number of factors, and I think we get lulled into this. I don't know how to say it, but in terms of all the China woes means that everyone loves India, which is obviously benefiting kind of flows, but that could change. The Chinese authorities have really just haven't used any kind of bazookas yet to fire the economy up, and that's causing a lot of kind of concerns and kind of reduction in confidence from businesses to the investors in that market. But if they do something, instead of using a pea shooter, they use a bazooka, then that obviously could have a very, very strong positive impact for not just for the economy, but investor thinking at the moment, which is, I would say, probably at its all-time low. So we're benefiting from that, but it's not enough of a catalyst to get our markets higher, right? So we have our own concerns about the monsoons, El Nino, and if you look at the kind of import-export figures, it's starting to drift down. So there's a bit of worry about the economy slowing now, which is okay, but I don't think that's taken into account in the valuations, which are still around 20 times PE compared to the rest of emerging markets. So we'll benefit from the China negativity, but it can't be just that one factor which is helping us.
Okay, by the way, the market is very quiet actually, not too much action happening in early morning trade. The Nifty Bank is quiet as well with just a bit of gains, but a couple of stocks do deserve mention. Adani Power is now up almost about 5% and Zomato is coming back, so 3% higher on Zomato. These platform companies have actually done quite well, and Lemon Tree Hotels at a fresh 52-week high. Andrew, good morning and thanks for joining in on the show. So you're saying that this is a market where there are not enough catalysts for the market to go up, and there is a bit of worry about the economy slowing down. So what do you do at a time like this? Do you, in your asset allocation strategy, do you move away from equities and into fixed income, into debt for a bit, considering we have these challenges upon us?
No, I don't think you need to take. I mean, for investors, obviously they can take a call in terms of that they're getting good yields in fixed income, and that's where you've been seeing a lot of investors shift money from in the short term away from equities. So as I said, there's no real catalyst. But we've maintained throughout the kind of past year or so that it's not the index that you necessarily should look at. It's the themes below the index which you should play, and we talked about these many times, and a lot of them have done very well, but to the point where there's not, even in those kind of areas, the valuations of and the share prices have moved quite quickly to capture some of that excitement for not just for the short term but for the longer term in those sectors. So that's where we're all kind of trying to find new areas, new companies, which will beat the index handsomely, and it's becoming a little bit more tough at this point because the overall kind of slowdown that we're starting to see is just starting to play through in the commentary by companies as well. So it's something I'm not overly concerned about, but it's something that will just take the edge off our market in the very short term. But so I don't think you need to do so much asset allocation between debt and equity, but I think a lot of people did at the end of at the back end of the year, right, in March, when the taxation changed.
Okay, all right. Hi, Andrew. Good morning. Nigel on this side. Andrew, when you joined us the last time around, ITC, that demerger was just announced. And from a longer perspective, obviously, it's quite positive. But that one has pulled back close on 10-12% from the peak, just in the last 1 month or so. View on ITC from a year on, because that's been one of the big outperformers actually in the past 18 months.
Yeah, I mean, in terms of, again, it's kind of one of those where the expectations were very high. Obviously, the hope was, the fact that they are de-emerging the hotel business, but it's going to take time, right? I think it's kind of a 12-month process. So if that's the case, then, that kind of short-term excitement of, creating value, it just goes away. And I think that's what we've seen also, say, with Reliance more in the short term. You create that value, it's in the price, and then, investors are waiting for the next catalyst, which is probably a little bit of time away. So, again, nothing to worry about in either of the stocks, but, that short-term kind of run that you saw in both of them was really buoyed by the fact that there was some demerger kind of news coming out, which was valuations, as you know, were kind of a lot higher, I think, or expectations were a lot higher than probably reality is.
Look at Zomato, which is up 4%, by the way. Stocks at about 94, and it's the second largest volume-led gainer across the board. The first is, of course, Adani Power with that big move, but Zomato is now at the day's high on large volumes. Patel Engineering, I mean, actually smaller and smaller names, right? I mean, Patel Engineering is up 3.5, big volumes. It's a number 4 with volumes. There is Birla Cable out of the blue, 9% move. Again, you know, for a stock like Birla Cable, volumes are large at this point in the day. Look at Morrison Laboratories, 6%. I mentioned Jupiter Wagons earlier. Bajaj Electricals is up about 4%. Voltamp is up 5%. So you're kind of rotating into lower and lower, you know, in terms of the market cap curve. Talbros Auto, I mean, that's a good company. And it's also done very, very well. It's up 100% this year. It's got a 8%, 9% move after the last few days of sideways kind of consolidation. So that is, again, I mean, but, you know, volumes are very small. So keep that in mind. So we're talking smaller and smaller. So, you know, just that point, Andrew, right? You have to go down and then find smaller stuff. So what does that tell you? I mean, you know, once you rotate and rotate and rotate and there's nothing left to rotate into, that hardly happens ever, right? You don't run out of stuff.
Yeah.
But,
you don't, but you could be the last man standing holding the stock when it starts to fall. So that's always the concern, Prashant. Listen, I think there's a few things that we just need to watch out in the near term. And I'm not being overly negative here on India. I'm very constructive in the kind of medium term. But, you know, we got Jackson Hole this week where the Federal Reserve will talk. I think it's going to be the same hawkish self, higher for longer. Bond yields are at 5%. 2-year bond yields in the US are at 5%. The yuan and the Japanese yen keep depreciating. Not good for emerging markets, to my mind. And we're still awaiting a stimulus from China. So if any of those things don't happen, I think markets are going to be tested in the kind of from September onwards, because there's a lot of hope. In terms of the Goldilocks scenario of a soft landing, which I don't remember ever seeing, and I've been in the market quite a long time, Prashant, as you have as well. And that earnings will be fantastic. Let's see what NVIDIA does tomorrow. If that can, you know, any disappointment there will obviously have a big impact on that AI kind of theme play, which is all over the place.
Okay. Well, you know, just before we let you go, I do want your thoughts on what one should do with the auto space now. I ask you because if you notice this month, in the month of August, the auto stocks have started to come off a bit. So Hero Moto, for example, is your biggest loser this month, down 10%. The others as well, right? Bajaj Auto, Maruti are coming off a bit. You think the upcycle has now ended, or would you use this as an opportunity to buy these names?
You know, I saw it's a very good question. I saw an interesting report the other day by a broker saying that discounts on cars have started to increase a lot more significantly than they expected. They weren't calling for a demand slowdown yet, but they were very close to it. So I think it will have to watch and see what those discounts, if they continue to be high, and then see if that's a demand problem, because that's obviously something that the prices might be trying to bake in right now, without the full evidence of being that it's a demand problem. It's maybe just discounts by the dealers to get things moving, but it's a worrying sign.
All right, Andrew, final question before we let you go. You know, a couple of domestic themes have come into play as well, but I think the bigger threat is coming from the globe. So how do you approach some of these companies, you know, the IT space in particular? The last quarter, well, it was more or less a weakish quarter, and visibility for the first half at least isn't really there. But valuation-wise, well, some of them are trading little above their mean, and they have good balance sheets as well, dividend paying. How do you approach the IT space from here?
I think I'd wait another quarter before wanting to kind of have full conviction. And the reason I'm saying that is twofold. One is I still think valuations are not taking into account potential downgrades in the next 2 to 3 months. But there again, I'm still of the view that interest rates will start falling in the US by the back end of the year, and that will be good for the technology stock. So I think we're just a quarter away from putting a more of a buy signal on the IT stocks. I just think there's in the short term there's a few headwinds which will bring the share prices down.
Right, Andrew, as always, great speaking with you. Thanks for joining us on the channel. Appreciate your thoughts.
Thank you.
That's Andrew Holland saying there's definitely some caution. Thank you. Some caution in the system prevails for sure. And the Jackson Hole Symposium, which happens on Friday, they're expecting some hawkish talk from Jerome Powell over there. But let's move on. The mid-cap index actually is picking up quite a bit, so don't be fooled by the headline index and the flatline move there. The mid-cap index is now up almost 0.6%. So clearly all the action is beneath the surface. Federal Bank is on our radar now. IFC has invested almost 959 crores in Federal Bank via the preferential allotment route. IFC's holding in Federal Bank has now risen to 8.1%. Also, Federal Bank's QIP of 3,040 crores is getting a very strong response. Harsh Duggar, who's joined as the Executive Director at Federal Bank, joins us now on the show. Harsh, thanks a lot for joining in and appreciate your time here. Wanted to start by asking you, post this fundraising, what would the cost of funds be in the near term? Would this help in controlling cost of funds? And what's the outlook?
Good morning, Sonia, and thanks for inviting us to the show. Yeah, the two parts. One is the cost of deposits, which we have seen an increasing place across the banking industry, but largely we have seen that getting priced in. So the last quarter probably saw the tail end, the fag end of the pricing in of the high cost of deposits. We are raising about 4,000 odd crores, between 3,000 crores for QIP and another 1,000 crores, 958 crores to be precise, for the preferential allotment. This will definitely help us in bringing down the cost of funds, but this is the cost of deposits still has plateaued out, seems to have plateaued out now.
Okay. That'll help you in bringing down the cost of funds. Got that. I want to talk a little bit about the overall business. There is this expectation that loan growth for you will be in this range of around 18 to 20%. It's something that you folks have spoken about in the past as well. But just trying to understand, where is the maximum traction coming in from? Whether it's from corporate, retail, agri, where are you seeing maximum demand? And this 18 to 20% is something that you can hold on to in FY24. And what's the outlook for FY25?
Yeah, we've been guiding the markets that we've been looking at growing at 18 to 20% growth, and we don't see a challenge over there. Both the rural demand and the urban demand has been quite fairly robust. Between corporate and retail, both sides we have been growing on average between 90 to 21% is what we have seen. The quarter-on-quarter performance and the year-on-year growth has been on those lines. In the wholesale side, we are seeing a fairly robust growth. We are seeing capacity utilizations increasing. And there's a demand coming in, whether telecom, the renewable energy space, or the data centers, the real estate, it's all signs of showing a pickup. On the retail side, the consumer demand remains robust. While the industry is guiding at 14-15% growth, we expect to grow at least 4 to 5% higher than the industry growth. So 18 to 20% is something which we are fairly confident about achieving.
Okay, all right. Hi, Harsh. Good morning. Nigel on this side, and congratulations on your new role. Well, just putting in that basic math of 18 to 20% for the next few years. Your current loan book size, I think, is around 1.8 lakh crore odd. That should potentially double, I think, in the next by around 2027 or thereabouts. But I just want to focus on a couple of aspects of your loan book. Your credit cards, your microfinance, commercial vehicles, personal loan. I think as of now, it's just around 8,000 on a base of around 1.8 lakh crore. And there is a lot of traction out here. From around 5% of your book, what do you expect the contribution to go to?
Okay, on an increasing book, we are looking at a share of roughly about 10% being contributed by the high margin businesses. Commercial vehicle, microfinance, credit cards, gold, and the MSME piece remain our clear focus areas. At this point in time, the MFI piece, the credit cards, and the commercial vehicle piece is about, as you rightly mentioned, about 7,000 crores. But broadly speaking, that's a segments which are growing at 60 to 70% right now, partly because of the lower base and also partly because of the fact that we see a high opportunities over here. To give you an example, in the microfinance, we were disbursing last year about 50 to 60 crores per month. Now we are averaging at over 200 crores a month. Similarly, for commercial vehicle, we've expanded our geographical footprint and covering pan-India now, and leveraging on the branch network and the DSA network. And again, over there, our disbursements per month has more than doubled. Similarly, on credit cards, we are at 2,000 crores plus in terms of size right now, but we are growing at about 50% odd, a little bit on a smaller base, but significantly higher. So we expect as a part of our total book to touch about close to 10%.
Okay, all right. Harsh, just a quick question. Okay,
Yes.
quick question out here. Your fundraise as well as the way you're changing your mix, your loan mix, it could help your NIMs. Now, your NIMs for the past quarter were at multi-quarter lows, but you'll have said that it'll recover from here on. So from around this 3.15% odd, what should be the broad range of NIMs for this year? That's FY24?
Okay. The NIMs have definitely been under pressure because what typically happens, the repricing on the loan book typically happens faster. So you saw the NIM expanding really fast and peaking for us in the Q3. And then you saw the deposit piece catching up. So we were at 3.2 in FY22, we were at 3.31 in FY23. And while the Q1 of the current year showed the maximum impact of the deposit repricing, we think that this is behind us now. And we are guiding a NIM of 3.3 to 3.35 for the current financial year. And we expect 7 to 8 basis points uptick in the next quarter and onwards in the NIM itself, because we see, one, the deposit repricing has already happened. Our impact of the high margin businesses playing in, we are seeing substantial traction over there. The other area which you're focusing on is obviously on the CASA side. It did see a fall, but you're looking at recouping that, especially the car piece. So all these put together, we are reasonably confident of achieving a 3.3 to 3.35 NIM, which we've been guiding for.
Okay, 3.3 to 3.35, you said. You were talking about how a couple of your businesses are picking up quite a bit, whether it's the CV business, the MFI business, and this is in high teens, the growth that you're seeing. What would this mean for slippages? Now, I know it's just a niggling worry, slightly higher slippages compared to what you did last time around at about 490 crores. And your slippage ratio, though, is still around 1.09%. But do you see any incremental pressure on slippages? What could the run rate be going forward?
No, we are still guiding at the same levels. We do not see any deterioration in the asset quality materially at all. 40-45 basis points is what we've been guiding for. And last year, Touchwood had been at a significantly better asset quality of 41 basis points for the full year. So we are guiding the same levels. We don't see too much of a traction. We are a reasonably conservative bank. So within those risk parameters, and obviously the situation is dynamic. So we have focusing on the high margin businesses, but reasonably risks boxed in. So we do not see the slippages going materially from where we have been guiding at. 40-45 basis points is what we'll be guiding for.
Okay, so you don't see a material deterioration in asset quality, and that's always a good thing. On the restructured book, your current restructured book stands at about 3,400 crores. Any update on that? How much of your book can go bad? And I'm assuming not much, but if you can just give us the numbers.
The restructured, we do not see any.
Harsh, a final question before we let you go. You'll have a couple of companies that are part of the group, which you could be looking at unlocking some value, insurance arms and the likes. Is there some kind of unlocking of value you could see in this year itself, in the current financial year?
No, nothing on. We are, which is there in the domain, we are looking at issue coming up for our subsidiary FedFina, which is there on the domain, public domain. At this point of time, we are not looking at monetizing our insurance piece at this point in time. So we are staying invested.
FedFina happens this year itself?
Pardon?
FedFina, you're looking at some fundraise, right?
There's an IPO coming in. We are filed for the DRHP. So we are looking at a fundraise at the FedFina level. Barring that, there's no other plans to monetize any of our investments.
Okay. One final question then from our end, Harsh. Since you've just taken on the mantle of Executive Director, and you have experience across several sectors, right, within banking, whether it's corporate, commercial banking, wholesale, etc. For the next 2 to 3 years, what is the longer-term vision of Federal Bank? I mean, what will the focus area be? Whether it is on the digital side, whether it is in commercial banking, retail, what have you set your sights to do over the next 2 to 3 years?
Okay, there are quite a few exciting areas. On the fintech space, as you're aware, we are one of the banks with the maximum number of partnerships, both on the marketing side as well on the cost processes side as well. We continue to remain absolutely engaged with most of fintech partners. In fact, we are the go-to bank for most of our fintech partners. So that's one area which we are, because we realize that while we go the physical aspects with the branch network at 1,370 odd branches, we're looking at expanding our physical footprint as well. But our partnerships, and especially our digital partners, is something where we are clearly focusing on. So that's one area. In terms of businesses, which we already discussed, commercial vehicle, microfinance, cards, gold will remain a thrust area. They are a smaller base, but their share in the business is going to grow materially. And this sector-wise also, we see a huge opportunity over here. Coming to the MSME piece, we are largely a mid-market bank. Between our commercial banking and business banking, we have about 33,000 odd crores as a book size. We are looking to grow that book materially more at 20% plus levels in the next near to medium term over here. So the clear focus areas would be on the tech and the digital partnership. Second is the high margin areas, which we are looking at that point in time. Cost to income is another thing which we hopefully expect to taper off. The last piece which we are focusing on is on the CASA piece. We are at a 32% odd in terms of a CASA mix. We are looking at how we can raise that materially by becoming a payments and collection bank. And that is something which we are rolling out, a complete digital platform for the corporates, which we are revamping it, which will take care of collections, payments, trade, supply chain. Supply chain is another area which I missed out, is an area which we are clearly focusing on, which gives a higher risk-adjusted yields to the bank. So these are the clear focus areas for the next 2 to 3 years. I do see the banking in general to be fairly exciting, and more particularly, I think Federal Bank is reasonably well placed in the sector to leverage on that.
Okay, all right. Well, Harsh, valuations as well are in your favor. Thanks so much for joining in and giving us the outlook that you have for the bank, and all the best in this new role. We look forward to chatting up with you rather soon. So those are the big highlights coming in from Federal Bank, looking at doubling their book in the next 4 years or so. NIMs will be in the vicinity of around 3.3 to 3.4%, and also asset quality will improve. Don't see any big risk on that front. For the time being, though, we'll slip into a short break. On the other side, we'll be joined by Mr. Jaya Sankar of Kotak Investment Banking. We'll talk about the heavy promoter selling across the market. Later on in our special segment, Charting Trends, Rahul Sharma of JM Financial Services will help us decode the charts and technical trends. Don't go anywhere.
Okay, welcome back. 40 points on the Nifty. We are actually looking better and better compared to where we started at 9:15. So definite improvement all around. Now the Motilal Oswal conference, of course, in Mumbai is underway. And we had Ramdev join us yesterday, the chairman and MD, joint MD at Motilal Oswal, who told us that one of the things he's noticing is that more and more foreign investors from different geographies, not just the traditional London, Singapore, US kind of geographies, but other newer geographies are also registering and showing interest here in India. So my colleague Nimesh actually caught up with one such investor. He caught up with two gentlemen, Fujimura Tariharu, the Chief Investment Officer at Asian Investment, the CIO of the Asian Investment Division, and Paul Simon, Deputy Head of the Asian Investment Division of Sparks AMC. Now, he began by asking them about the outlook for global as well as Indian markets from here on. Listen in.
I believe in the past, U.S. market or Chinese market led the worldwide stock market. But I believe now Japan is booming, but after Japan, I believe Asian equities time is coming, and especially India may be the very attractive market, I believe.
Sure. You spoke about India being an attractive market. Yeah. What's making you bullish on India? What are the ground level changes that you see which is making an investment case for an investment manager like you?
I think one simple idea is demography. Still, India is a very attractive country as a growing population. And the second point is global changes. You know, China used to be a worldwide biggest factory, and the US led the consumption. But now the world is fragmented, and the market demand is changing now. So I think India is very attractive in terms of supply chain shift or adapting to the variety of demand, I think, for the investors.
Sure. Paul, thanks for joining me, and pleasure having you at the conference as well. You manage the India portfolio, right? How do you construct the India portfolio sitting out of India, and what are the benefits or what are the opportunities that you see when you're constructing the India portfolio?
Thank you. I too am based in Tokyo, Japan, so we manage an India fund based out of Japan. And when we look at investing in Indian companies, there are two criteria. The company needs to grow at roughly 50% higher than Indian GDP, and the company needs to generate excess returns on capital of roughly around 5%. That's how we look at companies in general. And we, because of our legacy, Sparks is a legacy small cap firm. We focus on mid-small caps in Japan, though we do multi-strategy today. The India fund is also focused on mid-small cap, and that's where we think we can add a differentiator as a long-term patient investor.
Sure. Briefly, when I was having a word with you, you said large part of your investments is in the financials, whether it's banks or maybe insurance companies as well. Take us through your way of constructing the India portfolio and why you like financials in India.
So bulk of our portfolio is in financials. So there are two aspects. How we look at financials is in two aspects. One, there is credit-based and non-credit. It is safe to say that there is no Indian growth story without a credit growth story. So that part is quite obvious. What we think is more attractive is the non-credit part of it, whether it's insurance, whether it's asset management, whether it's brokerage, or the infrastructure plays like the data companies or the exchanges in India. So there are multiple themes on the financial space, and credit will be the bulk of our portfolio. And there, I think the biggest play is the big banks, which meet both our criteria. And we also find specific niche plays, whether it's in affordable housing, whether it's in gold finance, etc.
I'll come to you on the India part, but Fujimura, from a global perspective, how do you look at China, and are you even seeing a trend of a lot of money moving out of Chinese equities into the Indian equities?
I think now the worldwide money is coming out from China, and they're going to Japan or India or other Southeast Asian countries, I believe. Of course, depend on the variation. China may be the opportunity to invest in, but in the long term, not China, not Japan, India or other Asian country may be more attractive, I think, because of the growth.
So I understand you never used to travel too much to India, but now you've increased your travel and you want to come more and more into Indian market. So what are the sectors or what are the companies that you're finding attractive in the Indian markets?
I think, as Paul mentioned, I have been Japanese small cap fund managers, and the Indian market is same as Japanese small cap market, broad universe, and not covered, and huge growth potentials. So I believe not any industries in the mid and small caps. There are many good companies, I believe. So I rely on Paul to uncover new attractive small caps in Indian market.
Right. Paul, I understand you have a large exposure in the financials, the banking space, but I believe you don't have any exposure to either IT or pharma names, and especially pharma has done well in the last 6-8 months. So, what's your view on pharma? And do you think there is a bit of a miss out feeling that the fact that you don't have any pharma stocks in your portfolio?
Well, it would not be fair to say that we have no pharma exposure. Okay. We don't have any pharma export exposure. Okay. So we have domestic formulations plays. But on the export side, we don't see that as being an India growth story. And I think there are way too many variables, whether it is with FDA inspections or whether it's with product approval cycles, etc. So we think that it's too complex a name for us. And for us as generalist investors, we feel that a consumption-driven domestic formulations plays a much easier story for us.
Sure. The one big theme in the last 2-3 years in India has been the big outperformance of the mid-cap and small-cap. Even in Japan, you would have done some experiences on the mid-cap, small-cap in Japan as well. What are the similarities? And B, are you getting a lot of opportunities to invest in the mid-cap and small-cap space in India?
Yeah, so we think for us, it's two reasons, right? For us being based in Japan, we think that the large cap market is covered by excellent managers in India and also abroad. And we think for us, the differentiator is to take a longer term view, because we believe that in a way that we've time traveled. In Japan, we've seen a lot of these themes play out, whether it's in industrials, consumptions, basic materials, etc. And we're trying to bring that intelligence and see how we can predict how things will play out in India over the next 10 years. And across sectors, we see multiple opportunities. And we could say that markets have rallied quite a bit in the mid-cap space, but also we need to look at where they were in the start, where they're sufficiently valued, and what is the growth potential. So relatively speaking, we still think there's a lot of opportunity in the mid-small cap space.
Okay. What could be the key triggers that you'll be watching out for further increasing the India exposure?
Yeah, so in the space where we are, I think liquidity drives a lot of the pricing, especially in the mid-small cap space. So we'd like to let a little bit of the hot money get out, and then when valuations correct a bit, not that we think on absolute levels they're expensive, but from a liquidity-driven perspective, we think movements could be very volatile. So we're waiting for, let's say, slightly better valuation conditions. Yeah.
All right, interesting conversation there. Bullish on the India portfolio, particularly financials. So interesting commentary coming out there. But let's shift focus then to some market trends now. Now, in 2023 so far, promoters have sold close to around $10 billion. That's in this calendar year so far, and we still have 4 months to go. Now, that compares with close to around half that amount in the past year. Last week as well, there was big promoter selling in the likes of Adani Power, JSW Energy and Interglobe Aviation. To discuss more about these trends, well, we're joined by Mr. V. Jayashankar, the Managing Director and member of the board at Kotak Investment. Hi, sir. Morning. Thanks so much for joining in. Well, two ways of looking at it, right? One would be, hey, the promoters are selling big time. The other way would be, look at the depth in the Indian markets. You have $10 billion of sale from the promoter entities, and yet, in fact, it's all being absorbed and lapped up pretty easily that way. What's your comment on this? Which side are you leaning towards?
So I would put it this way. The domestic flows have been very strong over the last couple of years between the mutual funds and insurance companies. In each of the last two fiscals, that's 22 and 23, you have had about nearly $30 billion of money come in, right? And the FPI flows in the current year have been positive of about 19 billion, while it's been negative in the previous 2 years. So when you look at the domestic and foreign flows being equally positive, between them, probably in the current year, FPI flows about 19 billion, domestic flows must be 10 plus billion. So you have had about $30 billion of money coming into the market, all because of the India growth factor being recognized globally, and also investors in the Indian market, the domestic investors making not only good money, but also being very sensible about long-term investment through SIPs. So I would say it's driven primarily by a great deal of stability in the current year between both the domestic and the foreign flows. For the first time in the last 3 years, both are positive and quite attractive. And obviously, when you have these kind of flows, you need more paper. Otherwise, you obviously will have an asset bubble. And I think it's in this context, you should see a $10 billion of blocks. You'll also see about $10 billion of IPOs, maybe another $3 to $5 billion of follow-on. And to have this kind of a pipeline and a deal flow of about, call it $20, $25 billion, is very healthy to absorb, call it $20-25 billion of fresh flow. I would put it as the flows. The second factor I would say is the blocks have been quite prevalent, I would say, in the last 2 years. Even when the markets were down last year, we had in the last calendar year something like $7-8 billion of blocks. For example, you had Max Healthcare, KKR sell down $2 billion in the previous year. Similarly, you had others really taking out some money, both private equity investors as well as promoters. So the monetization of blocks has probably heightened the current year, but it was quite prevalent and prominent even the last year. And I think the blocks business will continue to see a good momentum for the next couple of years.
Hi, Jaishankar, and you were involved in that Max transaction as well. Prashant here. No, so yeah, flows is, you explained it very well. But on the other side, which is the fact that these are early investors and promoters themselves who are selling, what does that tell you? I mean, is there a signal to take? Even if it is very broad signal and can't kind of very specifically pinpoint and say that, well, this is what it exactly means. But is there a broad signal we can take about where they think valuations are vis-a-vis where they see opportunity, at least in the medium term?
Prashant, not necessary. I will tell you why. You should look at the block pipeline more in the context of how active the primary markets have been the last 3 years. So if you look at post-COVID, we had a number of issuances over the last 3 years, in particular in the calendar year 21. And you're seeing the private equity investors and promoters in those situations kind of monetizing. And to give you an example, for MPS compliance, Lodha had to do 7,500 crores of QIP over 2 transactions. Also, we had Manyavar doing a block of about 3,000 crore just a few months back. So MPS compliance forces a lot of promoters sometimes to really monetize and create the 25% minimum public float. In other instances, private equity investors who are holding significant minority stakes in companies, whether it's in Medanta, whether it's in Kim's Hospital, whether it's in Sona Comstar, you would see a number of issuances that have happened, 100-odd issuances in the last 3 years. There are private equity investors sitting with fairly large stakes. So it's only natural that you would see a fairly good block pipeline. The one thing that I would probably kind of highlight is in the current year, you have had more of the small cap and mid cap IPOs happening. So therefore, you will not see large blocks from the vintage of calendar 23, unlike 21 and 22, when you had large IPOs hitting the market. So it's also a function of what kind of size, what kind of market cap companies have when they hit the capital market. And I would say whatever blocks you've seen last year and this year is because of tech companies going public. For example, the digital tech companies probably have contributed more than $1.5 billion of flows right in the secondary market in the last 6 to 9 months, ever since they came out of lockup. You're seeing a lot of hospital companies getting listed, a lot of hospital companies, both the promoters and private equity investors, creating that MPS requirement.
Jaishankar?
And it is across multiple sectors.
Sure. Jaishankar, just one final question from my end. This is Sonia here. I get your point that it's very case by case and all of that. But if you look at the number, right? I mean, 80,000 crores of selling by promoters this year in FY23 is far higher than what we've seen in the last 5-6 years on an average. And generally, insider selling is considered to be sort of a red flag, at least for shareholders, investors, stakeholders. Is that the right way to look at it? Should investors be concerned with the kind of promoter selling spree that we're having?
Sonia, not at all. And I'll tell you why. I mean, if you look at Interglobe, for example, one of the promoters is selling out of a very planned exercise, which is quite public, right? If you look at Mahindra CIE, Mahindras have exited CIE. It was a good partnership between Mahindra and CIE that lasted several years. And now it's no longer a strategic position for Mahindra, so they have exited. If you look at Manyavar or Lodha that did listings where the promoters either did a primary or secondary block to create the MPS compliance, it's more to do with SEBI compliance. So I think it's all driven by either a P investor wanting an exit over a 3 to 5 year period, which is fair because the normal period for a P investor is 3 to 5 years. And when the markets are at its robustness, why not? And that's the right time to to kind of sell because the outlook is also pretty exciting for the incoming investors. And therefore, both for the exiting investor as well as the incoming public market investors, it holds a promise. And as far as promoters are concerned, you have to look at the context. And in India, with promoters getting comfortable about giving up control, or when there are multiple promoters, one of the promoter continuing to be the surviving entity, I think it's very, very likely that you'll see more of these transactions. So I think you should take it as a trend. And when the markets are robust, that's the right time for any block sale.
Okay, all right. Thank you so much, Mr. Jaishankar, for stopping by and giving us your comment. You know, when I put out this piece, the question that we were asking is, who's getting it right? Promoters or investors? Well, as you're clearly telling us, there's no need to worry from an investor perspective. This is part of the trend, some money being taken off the table. Maybe, in fact, it's, as of now, no need to really worry. But, Sonia, you want to take the next segment ahead?
Oh, yes. And, you know, as you rightly pointed out, I mean, this is important, right, from an investor and a viewer standpoint as well. When you see such large promoters selling, you sort of get rattled. But experts telling us that no cause of worry here. But let's get back to the markets and understand some charting trends now. Rahul Sharma, the Director and Head Technicals and Derivatives at JM Financial Services, is with us. So let's get to him. Rahul, thanks a lot for joining in. I want to understand from you what's happening on the headline index, because this has been a slightly painful, a slightly frustrating period for investors where the market has been in this really tight range. Do you think this consolidation phase is something that can continue over the next couple of weeks? And if yes, will all the action be in the broader markets now?
Yeah, morning, Sonia. So clearly, in the last 3-4 weeks, we've seen a downward grind in the markets. This is the first time since COVID we've had 4 negative weekly closes on the Nifty. The breakdown was becoming a consensus trade, in which is exactly why we're seeing a bounce back happening from 19 to 50 odd levels. Now, two forces at play here. One is you have a broader market which is not ready to give up. You have the mid cap and the small cap indices continuing to do well. The broader market participation has not waned out. On the second side, you have the aggression on the short side, especially from the FIs, has not gone up in the previous week. So in spite of the Nifty heading towards the 250 mark, we've not seen additional shorting in any way whatsoever from the institutional part, which is also the reason why we're seeing a bounce back happening. Now, in the very short term, I think once 19,500 is taken out, we should see the current consolidation, the current pullback or time correction ending, and then the Nifty getting back to where it is, which is on the way up, where we feel the 20,000 level should be taken out, and eventually we should be headed towards 20,800 by the end of this year. So this is a good opportunity to accumulate longs to buy in this correction. We feel the risk reward is still favorable. In case there is some amount of volatility, now 19,000 is a very solid base for the Nifty. Maybe around that, around 18,800, one can have a stop loss for long positions. Look to buy in this volatility, and we feel there is a good chance that the second leg of the rally moves starts beginning from here. What is also heartening to see is the sectoral rotation that is happening. So we saw banks taking a backseat, IT coming back into flavor and limelight, and we feel this is one sector which should continue to do well. We've seen PSE, the star sector amongst the market, and now we are seeing green shoots in the chemical space as well. So broadly, the markets are shifting, and this is a good and healthy sign that after a correction, we are seeing new leaders emerging.
All right. Hi, Rahul. Good morning. First of all, congratulations. This fitness mantra has worked out perfectly for you. So good on you, mate. But since we are here to talk about markets, and you're expecting the markets to gradually move towards the 20,000 odd mark. On the Nifty Bank, that one was the leader. It's taken a bit of a break. But what's the trajectory out there? What are the levels you're looking at on the Nifty Bank?
Yeah, so Nifty Bank is exactly the area where whatever shorts have been added in the August series have gone. So we started the August series or the expiry of July series somewhere around the 1.3 lakh contracts. Now that has gone up to around 1.5 lakh contracts. What is happening is Bank Nifty surely has sort of been an underperformer, and this would, the price performance would continue to be on the languishing side going ahead. So I'm seeing a sectoral shift where we may see banks sort of, not do so well as compared to the market. And I think there is a strong case for an IT versus bank switch over here. So we've advised our clients to switch from the banking space and get into IT, which has been a gross underperformer since last 18 odd months. And we feel there is a good bit of alpha to be created from this space. So Bank Nifty continues to remain under pressure. The short covering hasn't really kicked in. But having said that, I think IT is a better bet as compared between the two.
All right, we would have loved to chat some more, but we've run out of time, unfortunately. Thanks a lot, Rahul, for joining us and giving us some trends on the charting side. Let's slip into a quick break. On the other side of the break, Manisha Gupta will join in. She'll give us a quick roundup on the commodity market. Stay tuned. Welcome back to Bazaar Morning Call. Now, since the equity markets are very quiet, we thought let's take a quick look at what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, commodities have been under pressure since the US 10-year yield has risen to new highs. But tell us, what's the one commodity you're looking at today?
Thank you for that, Sonia. Well, I'm looking at metal as a sector, and we have put behind 3 weeks of constant declines for most of these metals. And this week hasn't started better, with the Treasury yields in US at around 16-month highs. We also are looking at the Chinese numbers not coming in as per expectations. Every data point that you saw come out of July in China was on the weaker side. And then the markets were anticipating a 15 basis point of a rate cut, but we saw 10, and the 5-year loan rate was not even touched. And then you have weak China imports in sense of metals. The real estate sector demand also has been on the weaker side. For many of the metals right now, we are actually trading on a discount because there is no on-ground demand coming in, and the inventories have been rising as well. I'll take the case of copper, where the inventories have gained up by 76% since 12th of July. Of course, when you look at a longer period average, we still are on the lower side. But from the lows, we have seen inventories really jump up. Same is the case with nickel, where inventories have gained up by 30% in last couple of months. Zinc inventories have gained up by 50% in 1 month itself. When you look at the zinc production as well, the numbers clearly are on the bearish side here. We have seen zinc inventories, first of all, trade at a 17-month highs there, and the demand has not been so great from the steel or the galvanizing industry, and that has been weighing on. Also, when you look at the demand that has been on the weaker side, the markets are looking at prices that have declined by nearly 24% from 2023 highs, and we are not too far away from the 3-year lows that the zinc prices saw in the month of May itself at below $2,200 a ton as well. The markets are looking at the international lead and zinc inventory numbers, and that tells you that the global refined production is up by 2.3% on a year-on-year basis. And when you look at the period from January to May, we have seen surplus of around 267,000 tons there. Also, when you look at the prices itself, in this week, we've seen the zinc prices decline by a percentage point, and they're down 4% in the month of August so far.
All right, thanks a lot for that. So big crack in commodity prices globally. Let's slip into a quick break now. On the other side of the break, our special segment, It's the Economy. Lata will get chatting with Jitanya Kandhari of Morgan Stanley for a money market chat as US yields have reached record highs and how this could impact the India growth outlook. Stay tuned.
Welcome to It's the Economy. The interest rate and growth pieces have changed rather dramatically in the global kaleidoscope. We have not seen 4.35% 10-year US rates for 16 years now. 2007 was last when we saw. On the other hand, US and Indian growth look fairly resilient despite the high rates, while China is slowing much more than anyone expected. Where does all this leave India as an investment destination? Is this well and truly an India decade? To answer some of these questions, I have with me probably the best in the business, an expert on global macros and markets, Jitanya Kandhari, Deputy CIO Multi-Asset Growth at Morgan Stanley. She also heads the macro and thematic research for emerging markets. Jitanya, pleasure, and thank you very much for coming by to the studio.
Thank you for having me, Lata.
Okay, let me start with what's really hit us, this 4.34% US yields. Initially, when Fitch made its downgrade, it looked like, it'll go above 4 and come back. But it looks like it's staying there. What's your sense? Are we in for higher yields for longer?
Yes, I mean, I have been of the view that, a Fed stays higher for longer because of the stickiness on the wage inflation side, which is just not consistent with the 2% target. And the long-term yields with that inverted yield curve were way too low. So you had an economy growing at 2%, you had job growth, you had credit spreads that were tight, and you had this Fitch downgrade with a lot of issuance coming up, and the marginal buyer now not being the traditional banks, and the foreigners also bringing down their demand for treasuries. So I think all of this is going to lead to slightly higher, I wouldn't say dramatically higher, but I think getting to like a neutral with the CPI, because if CPI settles at about 4.5%, a nominal yield of 4.5% is not abnormal by historical standards. So I think this stays higher for longer. We are in a regime shift, and we really need to adjust to this kind of interest rate regime going forward.
A year ago, we made these journeys above 4%. The US 10-year did do that, but it came back, and that's why as recently as June, it was 3.5, 3.5. But you're saying now we better be prepared for 4.5 for a goodish bit.
Yes, I do think, because I would get worried when real rates, which is nominal rates minus CPI, get into extremely positive territory. And we are still kind of neutral there. So what happens is when real rates go up, even historically, during 1860, the Civil War, during the World War I and World War II, debt to GDP exploded, just like debt to GDP in the public sector has exploded in the US now. The only way out of that situation was negative real rates. And we have to inflate out of that debt. And so if we are in that neutralish territory, I wouldn't be really actually too worried on the impact.
Okay, but impact on equities, for instance, you always discount valuations as the opposite of interest rates. So if we have to get used to 4.5, will there be an impact on EM equities, equities in general, even allocation to equities, because debt looks attractive?
Yeah, so I think, Lata, there's one interesting thing. In the beginning of the year, there was so much extreme bearishness on the US economy, a one-way consensus bet, 2-2 consensus for comfort. That's shifted, and that's why the markets have not done so badly. But I think from here, just overall, every year in the US markets, you have an average median drawdown of about 11 to 13%. This year, we've drawn down only 7% during the SVB fallout in the first part of the year. So to expect even a normal drawdown is, that's baked in our expectations, and that's how we're positioning. And on the yield side, I think for the first time, corporates and households are able to earn 5% on short rates. So I don't think fixed asset investors are really going to buy the long end in the overall asset allocation portfolio at this point till you really see that adjustment in the price, or I would really be a buyer when that real rate number starts looking concerning. So yes, I do think that there is going to be a drawdown in equity markets, just in line with normal yearly averages that we've seen in the past.
Fair enough. Okay, now let me before I come to the India story, which I want to ask you, just a word on China. I mean, with each passing month, the disappointment is only increasing. The property problems are not going away. Evergrande has, already filed for bankruptcy. So what's your sense? Do you think this is a longer-term downturn in China?
Yeah, I mean, I am concerned on China. I think the three issues with China, to sum it up, is one, it's overinvested, it's oversupplied, and it's over-leveraged. Yeah, India is the opposite. We can talk about that. So I think in that situation, any stimulus that is being put in place just doesn't have the firepower like the past. China has stimulated 4 times since the global financial crisis in 2008. This time, the fiscal stimulus the impulse is the least. There's just nothing left in that stimulus tank because of all these issues. And more importantly, the private sector confidence is collapsed. So in the past, every time China stimulated, the private sector doubled down. If China said buy houses, households bought houses. If China stimulated infrastructure and public investment, the private sector doubled down. And this time that confidence is not there. And because there are chronic issues, and as you brought up the property sector, which by estimates is nearly 25% of the economy, that sector, the government finance vehicles, were a very important part of that sector, because they sold land to property developers, they got the revenue from that land, and they invested those proceeds in infrastructure. Now they are not able to sell that land to property developers because the government is trying to right-size that sector and not stimulate it. So that's part of that same machine which is completely clogged. So even in this situation, their money supply is double that of nominal GDP growth. And first time China's nominal GDP growth has collapsed in sync with the real GDP growth. Where are the earnings going to come? So I am worried on the economy there.
Okay, so this is going to stay with us. Oversupplied, overinvested, overleveraged, and money supply also oversupplied. Okay, now let me come to the India story. I mean, it is a consensus trade. We just heard our colleagues speaking to even Japanese investors who are not very common. Do you think that this India story looks very good?
I really do like the India story. It is a structural story. It has whatever's not working for China, in summary, is working for India, right? It's not overinvested. It's starting a cycle. It's not oversupplied. In fact, capex is down, and it's not overleveraged. The balance sheets of the corporates all clean. So yes, you would need all these building blocks but I really do want to see the sustaining of this growth, which has to come from, increasing India's share in global exports, increasing manufacturing to GDP. I hear it everywhere while I've been here with Apple, with chemicals, with defense equipment, etc., with pharmaceuticals. I don't see it in the numbers. I really do want to see that FDI to GDP, the manufacturing to GDP pick up. Female labor participation is abysmally low. Even Saudi has overtaken India in the last few years. And finally, the fiscal deficit is still the worst combined in emerging markets. So I just hope with this election cycle coming up, there's no welfare spending that further causes that deterioration in that.
Actually, as you speak, those charts are running. As you can see, India at minus 8.9 is much higher than comparable countries, especially EM countries, in fiscal deficit as a percentage of GDP. And likewise, as you said, FDI as well, it's only about 0.8%.
Yeah, FDI is 0.8. Some of the Latin American and Eastern European economies have much higher FDI as a share of GDP. And what's interesting is the last few years that FDI has actually reduced, even in India, pretty significantly. So I'm not saying that I'm bearish on India, but I really do want to see all these pieces adding up so that we could see the sustained decadal growth that we are all hoping for. And the only thing I'd say, it's just become such a consensus trade, and you don't really always love a consensus trade.
Yeah, consensus trade can have, it's like who else is left to buy if everyone is already bought, could be a worry. But things are, the macros otherwise, as you say, current account deficit, inflation, growth itself are all working in favor of India at this point in time. But now let me start with sectors. You just spoke about how the rates can remain high for long. if they are that high in the US, 10-year is at 4.5%, say, for the next 1 year, then is it likely that Indian rates can fall at all? Is there any scope to cut rates in India? And if that is the case, this consensus trade of financials, everybody wants to own banks. Do you think that that is at its, is peaking off?
Yeah, so, interestingly, I think this whole rate cutting cycle in emerging markets was a phenomena for the first part of the year, right? Countries like Brazil raised rates 13%, they're unprecedented levels, because EM central banks have really been orthodox in their monetary management, unlike the past, which is why even though now Treasury yields are backing up in the US, some of these EM local debt markets are actually doing fine. They're not behaving like in the past. So I think that story on rate cuts, a bulk of that is spent, because now with Fed rates being higher for longer, the interest rate differentials will start mattering at the margin. In terms of the impact of interest rates on banks, we've done a lot of work on this. And what's really interesting is in some countries, the bank's net interest margins actually benefit with interest rates going up. And in some countries, that works the opposite. So interest rate cuts are needed to start the loan growth cycle. So I'm a little mixed on that, but I do think that there can still be some cuts in emerging markets.
No, but what I mean is that you like interest rate sensitive stocks. You like banks in India. Is there something else you can give our viewers?
Yeah, I do like the industrial theme globally, right? Because I think there are, I call it the 4 C's of CapEx globally, right? There is defense CapEx, there's green CapEx, there's resiliency CapEx to build supply chain, and there's substitution CapEx because labor is so expensive overseas that you need to substitute with capital. So the industrial theme is a big theme, in my opinion, globally. And some of those stocks are holding up. They are expensive in some parts of the world. But as a sector, I think you always want to buy areas where the world is underinvested. So I think that's another sector I really like.
And just one final question. Services exports. It looks as if the middle office everywhere is moving to India. GCCs,
Morgan
global.
Stanley as well.
Exactly. So you think that, how will you play that theme in India?
So I think that theme is a play on consumption, right? On housing, because that will create housing, it'll create consumption, it'll create financial services. So I think it all kind of stimulates the overall growth story. And what I hear, interestingly, even from our offices, is that now they are finding even better skilled employees. So work in India, made in India, now with, Gift City, invest in India, invest from India. I mean, they're all great steps.
Okay.
All good.
So maybe this one's the consensus is right after all. Jitanya, it's a pleasure having you with us in the channel. And we are ending it on a high note, wrapping up on Bazaar. Chartbusters up.